Welcome back to another edition of the Macro Minutes Investment Show here on the Samaritan Financial YouTube channel. My name is John Burrell. I'm the strategy manager, and I'm here with Chadwick, the IT administrator. How you doing?
Hey, I'm doing fantastic. Hope you are.
Yeah, doing good. We have a great show for you today. We're going to go over the market overview of what happened in the last week and what you got to look forward to in the week coming. First, we're going to look at the Shiller PE ratio. Now, this is something that we've been keeping an eye on for the last few weeks. We think this is an important factor in what may be to come in the stock market, specifically the S&P 500. Now, this chart shows the Shiller PE ratio of the S&P 500. It's the average inflation-adjusted earnings from the previous 10 years. So right now, we're at a 40.30 on the Shiller PE ratio. In the 2000s, during the dot-com bubble, it got as high as the high 40s on the upper end. That was the highest that we had seen it since 1880, as far back as this chart goes. So we're very elevated as far as the price you're paying for the company's earnings adjusted for inflation. Go into our second story, which is really not even a second story. It's a continuation of this same outlook of the market. The Russell 2000, which is the small cap companies, whereas the S&P is the large cap companies, 40% of the Russell 2000 companies are unprofitable. So this goes in hand with what we're seeing in the S&P 500, where you're paying an extraordinary price for very little earnings, but in this case 40% of the Russell has no earnings whatsoever or unprofitable. So this continues to say, are we in a bubble? Now, with this talk of are we in a bubble and are things cooling off in the economy, the Fed has a decision to cut interest rates tomorrow, which most likely we will see happen. Now, unlike the headlines where people just talk about their predictions or what they think is going to happen, we're going to look at another market that's different than the stock market to see what is the expectation that the Fed cuts rates tomorrow. Fed decision in December on the Kalshi market. These are betting markets that are free markets. They're not just like a betting against the house. But on the Kalshi, it says there is a 96% chance that the Fed cuts by 25 basis points tomorrow. So with that being said, the Fed sees the economy as slow, and as the stock market's price stays high, I think we are looking for a correction in the stock market coming soon. But with that being said, we don't just go off of what we think is going to happen. Even if we do have things that support it, we're going to look at our trend model. Now, if we move to the charts here, we're going to look at our trend model levels and see where those crucial levels are that we're going to use to invest. So right now, the S&P 500 futures market is what we use for a proxy to look at the S&P 500. The ES is at $6,849. Up here at the top, we had a little bit of a pullback of about 5% before it rebounded. Our trend level is at 5,970. Now, historically, it's better to stay into the market so you don't get chopped in and out, because if you would have got out after a 5% decline and then the market rally, you would have missed out on profits. Or if it just chopped around that percentage, then you would have lost money. So you really want to stay in as long as you're above the trend, or that's what we do. If you look at the NASDAQ, same story here. NASDAQ's at 25,687 as we talk about it here in after hours. The trend level for it is down here at 21,149. So it is bullish trend as well. Now, instead of talking about just bullish stuff, we're going to look at oil. It's our first thing that we look at that is actually bearish. Oil is at $58.38. Its trend level is at $68.93. So it is quite a bit bearish on oil. Now, flipping right back to the bull side, we have gold at $4,237. Close to its all-time high. It's just been raging bull market for gold. Its trend level is at 2,918, so it has quite a far way to go before it would hit a trend level that would get us out of the position. Looking at silver, Same case for silver at $61.41 for silver. Its trend level is at $31.82. And I'm not sure what the all-time high of silver is, but I'm going to back it up here and see. It looks like we are at an all-time high for silver as well. Its previous all-time high was right around $50 an ounce, and now it's 61. Looking on over to Bitcoin, Bitcoin's currently at 93,000, and its trend level is at 87,945. This was something that was bearish and now has switched to bullish on our model. So you've heard it here first. Bitcoin is now bullish. And that is our chart recap and our market overview for this past week and what to look forward to going forward.
Yeah, super interesting. Keep your eye on that Bitcoin.
Yeah, Bitcoin trading at 93,000. I remember when it was still at 3,000. It was a long time ago.
Baby.
Yep. Now let's look at the S&P 500 total replacement strategy that we built here at Samaritan Financial.
All right.
The S&P 500 total replacement strategy is if you like investing in the S&P 500 but you don't like the large drawdowns, we built a product that protects against the downside but still participates in the upside. Now the S&P 500 total replacement strategy is currently down 1.6%. and its max drawdown is 7%. Now we just started this 37 days ago or so. That was when our first trade went off, and it follows the S&P 500 very closely. But when you have big drawdowns, like more than just 7%, when you have a bigger drawdown like 10, 15, 20%, that's when we will start to outperform the S&P 500 because we're going to protect against that downside with our trend levels. So like you've seen when we were on the charts, our trend levels really tell us when to get in and when to get out to protect us for that downside, but still allow us to make money on the upside. So that's our total replacement strategy. If you want to check this strategy out right now, we have a discount. You can click the link in the description below. It is for $5 a month for the first 3 months, and then it is $75 a month after that. But if you want just the signals, that's how much that will cost. But if you want to automate this process, it's extra $55 a month, and you can automate this process, and it'll be all hands off, and you'll get all of our trades in your brokerage account as well. So that was our S&P 500 total replacement strategy. So if you're interested in that, please do check it out. We think it's going to be crucial as we were talking about the bubble that we're in right now, the super high evaluations that the market's in. We can really protect the downside. But this is the time to look into our strategy and be an investor in it versus waiting until those big drawdowns actually happen. Because once it happens, you're going to lose the money, and then you're going to want to come to us. But you want to come to us while you still have all your money, not while you've lost it. While you're not lost a lot of money. Yeah, that's the idea. So with that, we're going to go to our educational corner and talk about capital efficiency. Now, maximizing your capital is so important. And with capital efficiency with futures, that's what you can do. Now, this is the biggest reason why we use futures, not only for the liquidity like we talked about in the previous episodes, but also for the capital efficiency. Now, capital efficiency is leverage, but leverage gives it a negative connotation. What we want to use is our capital in the most intelligent way that we possibly can. And to do that, we don't want to leave money on the table, and we also want to make smart decisions. Well, one of those decisions that we can make that helps improve our portfolio and improve our returns is to use our capital in the most efficient way possible. And so basically what that does is if you are investing in something like this pen, for example, if you invest in this pen, and the price of this pen is, say, it's a $5 pen, right? It's a premium pen that you're paying. But the fluctuation of this pen only moves by, let's say, 50 cents. If you put $5 up to invest in this pen, but its normal fluctuation is only plus 50 cents or minus 50 cents, then you're putting a large amount of capital relative to the movement of its price fluctuation. So instead of putting up the full $5 to participate in the price fluctuation of this pen, you would only put up like $1. And in the futures market, this is what is known as the margin. So your initial margin that you have to use. So instead of putting up the full $5 for this pen and all that money has to sit there for a 50% or for a 15-cent move, you can put up $1 to cover the move of the price fluctuations of this pen and still get the return. And that is this week's educational corner on capital efficiency. What's your thoughts?
Sounds to me like getting the most market impact with the least amount of cash is the name of the game here.
Yeah, making money work smarter, not harder.
Well, talking about capital, the feds keep talking about these rate cuts like they're future Christmas presents. No one's unwrapped them yet, but you know what? At least we're still all invited to the party.
And speaking of the party, I hope everyone has a great holiday season this year. Thanks for joining us on this week's edition of the Macro Minutes Investment Show here on the Samaritan Financial YouTube channel.
All right, stick with it, guys.